Welcome to the accounting discussion to the preparation of financial statement series. In this session, we'll see the preparation of financial statement when the opening balance sheet is given and a set of transactions are given. The opening balance sheet means the business is there, has already been operating. So purchase stock on credit. So creditors 50,000 and the stock increases by 50,000. No payment but an acquisition of stock resulting in creation of creditors. Sold entire stock for 180,000. Sales 180,000 on credit. So there is no cash flow. So the debtors will increase by 180,000. Debtors will increase by 180,000. And whenever there is a sales, there has to be cost of goods sold and entire stock sold. So cost of goods sold is 80,000. So as a result, the stock in the balance sheet will become zero. The stock is equal to, we can see the change in a stock. The stock purchased, the stock was 30,000, purchased 50,000, sold 80,000, 82,000, so stock is zero. Expenses for the period is 20,000 and fully paid along with the outstanding expense. So expense paid is equal to 8,000 plus 20,000, so 28,000. Now the outstanding expense will become zero because the company has paid entire 28,000 during the period. You can see that. So 8 plus 20 minus 28,000 is 0. Depreciation for the period is 20% on the original cost, so 0.20, and depreciation is not an outflow but the reduction in the value of the asset. So the accumulated depreciation goes up to minus 16,000. Interest on the loan, even if not mentioned, we have to show interest because of the accrual principle. So 0.6%. Let us write down here is a 6% is the rate of interest, and let us assume that interest is also paid during the period. So no outstanding interest. Once all expenses taken care, sum up all these expenses, find PBT. PBT is equal to sales minus the expenses. Assuming that taxable profit is same as PBT, we calculate the tax at 30% and also make the payment of the tax during the period. So the PAT is 64,000 minus 19,200, and PAT will be included in the retained profit, and as and when we distribute, we reduce the retained profits. During the period, company declared a dividend. So dividend is not an expense but a distribution of profit, and it is calculated on the capital. So 50% is distributed as dividend, but it is not shown as an expense but the reduction of the retained profits. So we can see the change in the retained profit. The retained profit was 47,600 plus 44,800 minus 25,000 is the balance of retained profits. Now we can find the cash in hand. Opening cash in hand was 146,000. No cash inflows during the period. The total cash outflows during the period is 78,000. So the cash available minus the cash payment is the cash in hand, and cash in hand will be shown on the balance sheet as an asset. No change in the capital, no change in the loan. So the sources side total at the end of the year is 267,400, and the total of the asset side will also be equal to 267,400. So every item, every financial decision that you take will find a place in the balance sheet or income statement or cash flow statement. Once again, we can see the interrelationship between the balance sheet and income statement and cash flow statement. Every item on the balance sheet is either dependent directly or indirectly on the income statement and cash flow statement. Thank you very much.